Hello, everybody. Welcome to another episode of the 239 Real Estate Roundtable podcast. Today, we are going to talk about why price changes happen. We're going to talk about supply and demand in the housing market, how we got to where we are at today, and what the future might hold. So, if you've ever wondered why home prices go up or down, it basically all comes down to two things: supply and demand. So today I'll break it down using simple graphs that you can understand and exactly how the housing market works and what it means for buyers and sellers. In advance, I apologize for my horrible drawing, but I hope you can get something out of these graphs. Okay, before we get into some graphs, supply and demand is the basic economic principle that determines prices. In real estate specifically, it works like this. Supply is basically the number of homes available for sale, and demand is the number of buyers looking to purchase homes. So when these two forces shift due to various reasons, home prices respond. So let's take a look at some scenarios in the real world.
So I pre-drew this graph here. So let's back up real quick a little bit to middle school and remember how this reads. So you have the axis here at the bottom that signifies quantity, Q for quantity. And then you have this axis right here which signifies price. So P for price, Q for quantity. So then you have this line here. This symbolizes demand. And then you have this line here, which signifies supply. Okay? So, and then here in the middle, this point right here, where these two lines intersect, is called the equilibrium point. Okay, so this is how economists would refer to this. So this is a simple supply and demand graph or diagram, whatever you want to call it. Now, let's back up about 5 years during the COVID time. So let's say this is the housing market in 2019. It's in equilibrium. There's this constant kind of shift between supply and demand, but overall things are good. They're healthy. In some markets there might be an oversupply, in some markets there might be an undersupply, but overall it is a healthy, functioning market. Okay, and then this thing called COVID happens. Okay, and during COVID, factories cannot produce the same output that they used to be able to produce. There's not as many container ships that are being allowed to dock in the ports of the United States of America to offload valuable housing supplies that the builders in the United States of America need in order to build the homes. There's not as much wood coming down from Canada that also builders need to build houses. And so this whole supply line actually completely gets shifted to the top left. Okay, so we're shifting this here to the left because this would indicate that there is going to be less supply. Remember, Q stands for quantity, so less supply. Okay, so we're going to shift this here. Okay, now our new equilibrium is going to be right here. Okay, you can see on the price axis, we just went up. Okay, now let's also say that during the coronavirus, the government wants to keep the United States economy alive. Okay, they don't want to crash the economy, they want to keep it alive. And let's just say the United States Treasury gives every United States citizen $1,000 or $2,000 straight into their bank account that they are free to spend. Now, let's also say that the Federal Reserve, in order not to have the economy slow or crash or whatever word you want to use, lowers interest rates so much that the average mortgage rate is lower pretty much than we've ever seen. Okay? The reason why the Federal Reserve lowers the rates is because it becomes cheaper for everybody that participates in the United States economy to borrow money. Okay? Now, why is that a big deal? Number one, it motivates us as the normal consumer to borrow money for that new fancy car. It enables us to borrow more on our credit cards to spend at Louis Vuitton. And it also enables us to buy more house. Okay, so it just allows us to take on more debt. But it also allows businesses to do the same. And usually there's these huge growth spurts that happen. Okay, so now let's say, like I said, rates are low. Everybody has extra cash to spend because of the stimulus checks. So what happens with our demand line, right? Our demand line is going to go up, right? It's going to go to the right-hand side. It's going to go higher in quantity, okay? I'm a little bit running out of space here, but let's just say it goes up a lot, which it did. I mean, demand for houses during COVID was crazy. I mean, another factor that also contributed to that, people wanted to get out of their apartments. They wanted to have that space so they're not in constant contact with people. So all of these factors got us here. Okay. Now, again, looking at our equilibrium point, we went up even more in price. Okay. So just to recap, supply, I'm going to write supply here. So supply goes down because of COVID. Okay. Manufacturing goes down. And just the global supply chain just completely falls apart. Okay. It just completely falls apart. Okay. So there's less houses. Okay. Obviously, this doesn't affect existing houses, but in the United States, we tend to not have enough homes for kind of the population. But that's a topic for a whole nother video. But there's not enough new houses that can keep up with the demand. Okay. So we go from this point to this point, and then pretty much simultaneously, demand goes up. Okay. Why does the demand go up? Because rates are low. Okay. Stimulus checks. And people want to move into single family homes. They want to get away from their neighbors and their apartment complexes, and they're spending more time at home, so they want yards. Things that were important in 2019 are suddenly not as important anymore, and other things become more important. So I'm just gonna write consumer behavior. Okay, so this happened during COVID. That's why we are where we are at today. It's come down since then, which I will show you guys now. All right, I just redrew this again so it doesn't become too busy on the other sheet. But remember, we're in an environment where demand is extremely high and supply is extremely constrained and extremely low. Therefore, prices are very high in the United States housing market. Okay. Now, the United States, and more so the Federal Reserve, realizes, well, inflation is outpacing the wage growth of the average American. Okay, so this is not sustainable. People can't afford things are getting more expensive, but the wages in order to sustain that is just not keeping up. Okay, so the Federal Reserve decides to pretty much double interest rates in a matter of 1 to 2 years. Okay, now remember earlier I said lowering rates spurs demand, and the same is true for increasing rates on the opposite spectrum, right? So you increase rates, it slows down demand. Okay, there's less businesses that are taking on debt. There's less investments that businesses make into new production facilities, and just there's less money being spent in the United States economy by us as a consumer. Less credit card debt, less auto loans, less houses, so on and so forth. Okay, so this whole line gets shifted to the left. Okay, we're going the opposite now. Quantity of demand is going lower. Okay, so let's just say we're going here. Okay, so our new equilibrium point is right here. Okay, so as you can see, our prices are coming down. Now, of course, every real estate market in the United States is a little bit different and unique, but I'm just describing the overall economic concept that is happening right now, and what the Federal Reserve is trying to achieve, and just what I'm seeing as a real estate agent out in the field every day. Okay, now, so this is where we're at right now. Demand has come down, rates are down. In my opinion, this is where we are at right now. Okay, now let's talk about the supply line. The supply line has held pretty steady overall, and that's really what's been keeping this real estate market alive. Okay, now why has the supply line stayed pretty steady? Well, it has something to do with what we refer to as the lock-in effect. Okay, so there's not as many existing homeowners that are putting their property up for sale, because a lot of people that purchased homes during the COVID era and before, they're at a under 3% rate. They're in the threes, they're in the fours, but I mean, they're definitely going to be under 5%. Okay, and they're locked into that rate for 20, 25, 15, 30 years, whatever it may be. So a lot of people that bought a home right now, they just don't want to go from a 3% rate to a 7% interest rate. I mean, especially not, when the economy is softening, people just don't want to almost double their payment. I mean, prices went up in the homes, because remember, we're still higher here than we were pre-COVID, right? So prices are, even though they're kind of coming down overall, or at least that's kind of what's happening, right? Here in Florida, we're definitely seeing this. I mean, I know other real estate markets in the nation, they might have barely moved now, but I mean, basically, just to generalize a little bit, that's what's happening. Okay, so we're still higher on the price than we were in COVID, right? So people just don't want to give up their 3% rate and double their rate and increase their payment by hundreds, if not thousands of dollars. So that's one reason why the supply line really hasn't moved much. Okay, and the other thing has to do with equity and foreclosures. Okay, so people that bought homes in 2015 to 2022, they have a lot of equity. I believe as a nation, we're sitting on the highest amount of homeowner equity in the history of the United States. So people can stomach this. Okay, people can stomach this price drop. People aren't really freaking out too much. at least not people that actually look at the data and don't maybe believe everything that they read, but people can stomach this price drop. Okay, so things are staying steady. And the other thing is foreclosures. So one of the big reasons why 2008 happened was because of adjustable rate mortgages and these, unsafe lending practices, I'm just going to call them. So nowadays, most people that have a mortgage they're fixed rate mortgages for 15, 20, 25, 30 years. Okay, so it gives people a very predictable monthly housing expense. Of course, property taxes tend to go up, insurance, things like that, but it's not like 2008 where you finance a loan for 5 years and then all of a sudden, your rate goes from 3 to 7 and you don't have a choice, right? Your payment goes up hundreds of dollars almost instantly overnight. That's not what's happening right now, right? People are locked into their rate and it gives them a very predictable monthly expense when it comes to their housing. Another big difference to 2008 is that there were huge improvements to the general lending practices in the United States after 2008. So most people that buy homes today and that bought homes recently and that bought homes in the last 10 years, they actually qualify for those homes, okay? If you've ever bought a home before, you're sending in pretty much everything in your financial history you're sending in, okay? So, and that's just for underwriters and the mortgage companies to make sure you can actually afford this home, not just today, but maybe also down the road in 10, 15, 20 years, okay? So there's a lot of equities sitting in these homes. People aren't really freaking out, and there's not many foreclosures happening due to the reasons that I just explained, okay? And in my opinion, that is really what has been kind of saving this current housing market, okay? So this is where we are at right now, especially in Florida. I believe we are kind of already here. I know other markets in the United States where you're transitioning. Obviously, this stuff doesn't happen overnight, and this does not look the same for every single housing market in the United States. I just want to be very clear with that I'm doing a very generalized explanation of how this stuff works. Now, you might ask, well, what could one and two, these two things aren't happening, but what could maybe push this line a little bit farther as far as the supply line and prices drop even more, right? So, a few things that could happen here. I'm just going to mark this, right? What would increase foreclosures and things like that? Well, what if people can't make their payments anymore because they lost their job? Okay. Now, we're not seeing this. The job market is still very strong. Unemployment's still low, and the delinquency rate and the foreclosure rates are extremely low. So when people say, hey, housing market's crashing, I would call it more of a correction, but hey, this really is for you to kind of make your own opinion of what's happening. But what could obviously push this supply line further and therefore put some more downward pressure on the pricing is more foreclosures, more homes hitting the market, and that would pretty much happen through higher unemployment and the job market really slowing down. Okay, so I hope this is helpful. Now, when you hear things like, a couple things that you read a lot in the news is, the median sales price, right? You hear days on market, right? You hear supply, which is really just another word for that is listings, right? Pending, active listings, new listings, things like that, right? So these are kind of some things you hear in the media: median sales price, days on market, supply, listings, things like that. Obviously, affordability is a big thing that gets tossed around a lot. And all of these words pretty much, it can all be explained with this very simple graph: supply and demand, prices, quantity, things like that. So now you know how not just the United States housing market works, but also a lot of other industries and markets across the world follow this same kind of pattern. There's more to this. Like I said earlier, for us that have studied economics and finance in school, I know this is very top level. We're not talking about elasticity and oversupply and undersupply and those kind of things. But I hope this helps.
All right, there you have it. So what does this all mean if you're buying or selling a home? So buyers, I mean, if you can afford today's rates, you're definitely going to have more negotiating powers as inventory rises. Like I mentioned earlier, we in Florida, the couple last buyers that I've represented, we have seen some deals that would have been unthinkable 2, 3, 4 years ago. Sellers, if you absolutely have to sell, pricing correctly is absolutely key. Overpricing in a shifting market can lead to your home sitting unsold and expiring off the market. So understanding supply and demand helps you make better real estate decisions. If you found this helpful, please make sure to like, subscribe, and drop a comment with your thoughts on the market in your hometown. Thanks for watching.